Hi everyone, welcome to Lighthouse Financial Planning's fourth quarter client webinar. My name is Jeanette Salmon and I'll be monitoring the webinar this afternoon. Our presenters today will be Jim Johnson and Debbie Gross, and Jim will be talking about the economy and the market outlook, the election is over, what now, and the fiscal cliff and other scary things. Following Jim, Debbie will talk about financial planning topic, year-end tax planning, what can you do now? And before Jim gets started, I'd like to go over a few housekeeping items. On the right-hand side of your screen, you'll see the Go To Webinar window. On the left side of that window, you'll see an orange arrow. By clicking on that arrow, you can either minimize or maximize that screen as you desire. And also for your privacy, I just want to let everyone know that you will be muted during the webinar. We'll be recording the webinar and expect to have it uploaded to our website within a couple of weeks. So you're welcome to re-listen and share the information from today's session. And with that said, I'll hand it over to Jim to get started.
Thank you, Jeanette. Welcome, everyone. Hope you had a great Thanksgiving weekend, and we're all looking forward to a wonderful holiday season. So, what I'm going to talk about today is, now that the election's over, what now, so we'll look at what could happen, what we think might happen. We're going to break our rule and look at our crystal ball a little bit. We'll also take a look at how investments have reacted to other crises. I wanted to let you know today, too, I've also inserted a number of quotes today that seem to be relevant. So from Theodore Roosevelt, it's difficult to make our material condition better by the best laws, but it's easy enough to run it by bad laws. So my idea here, obviously, is that the government probably won't make things much better, but it sure could screw it up if they don't do right. So let's take a look at the fiscal cliff. And on January 1st, a slew of new tax law changes and spending cuts are poised to take place. The Bush-era tax cuts will expire. The alternative minimum tax will snare more taxpayers. The payroll tax holiday will sunset. And the new investment surtax to pay for the Affordable Care Act, otherwise known as Obamacare, will take effect. On the spending side, defense, discretionary spending and entitlement cuts are on deck, and unemployment will be scaled back. All in all, these cuts and tax increases could amount to, by some estimates, to more than $700 billion, and could shrink the economy by as much as 4.5% of GDP. Now, during Debbie's section, she'll be talking more about some of the proposed tax law changes, some of the things we think that you'll be looking at, and things we think that might not take place. But anyway, that's what, if everything, that's why they call it the fiscal cliff, because a 4.5% hit to GDP looks like this. So in the third quarter of 2012, our most recent number, the U.S. economy grew by 2%. If the fiscal cliff hits, all aspects of it hit, there'll be a decline in GDP of 4.5%. Do the math, and the net effect is a minus 2% of GDP. That's the definition of a recession. So how do we respond? Well, first, another quick quote for you. And the thought here is to suggest, don't get caught up in all the political and media madness about all this. The political rhetoric will be hot. Count on that, but don't buy into it. Behind the scenes, there's a lot going on we don't know about. So let's talk about what's going on in the U.S. economy today. So one of the facts is that the European fiscal crisis is way different from what the U.S. faces. Debtor nations like Greece and Spain do not fully control their economies because they're lashed to the German austerity policies through a common currency, the euro. That means that those countries do not have their own currencies to devalue, which could spur exports. Nor do they have a central bank like the U.S. Federal Reserve, which could provide liquidity for their banking systems. The United States does have long-term fiscal challenges and years of unsustainable trillion-dollar budget deficits that need to be dealt with. But our problems are largely due to the fact that we're still groping our way out of the worst economic downturn since the Great Depression. So slow but persistent economic growth will reduce many of our budgetary problems. For example, global confidence in the U.S. economy is reflected in the near record low interest rates available on 10-year and 30-year Treasury bonds. Interest rates are driven by demand. So the low interest rates mean that investors around the world are willing to tie up their money for 30 years in Treasuries for the paltry interest rate of 2.8%. So what if Congress misses the December 31st deadline to extend the Bush tax cuts? It's kind of part of a shell game. The Treasury Department has wide discretion in the pace in which it instructs employers to adjust their income tax withholding rates. Chances are Treasury will do nothing in January to change rates for anybody earning less than $250,000 a month, or $250,000 a year, which is most of us. Meaning a temporary increase for those wage earners would be a fiscal distraction rather than a real-world wallet crunch. And when Congress and the President do get around to the inevitable tax deal, the new lower rates will be retroactive to January 1st. Make no mistake, some people will see their taxes increase. For the past 2 years, most people in America have benefited from a 2% reduction in payroll taxes, a cut designed to stimulate the economy in a period of high unemployment. But the payroll tax cut was always supposed to be temporary rather than a permanent rate cut. While nothing is certain, chances are the payroll taxes will revert to their normal level next year. That was the rough number in the 2010 Simpson-Bowles deficit reduction plan, and it carried over to Obama's abortive 2011 negotiations with Republican House Speaker John Boehner. So $4 trillion is not any magic number. It's just the one that they've been throwing around. Everyone wants credit for tackling the deficit, but nobody wants to be blamed. As recounted in Bob Woodward's book, The Price of Politics, a dramatic moment in the 2011 Obama-Boehner negotiations came when the two men battled over boosting the age to qualify for Medicare. Boehner wanted the age change to take place in 2017, while Obama wanted to hold out until 2022. That is what Washington is in a nutshell. Both men wanted to postpone the pain until they retired from office. They wanted to bask in the glory of reaching a grand bargain on the deficit with all the complications reserved for a future president and House Speaker. So, what might happen? I'm sorry? Yes. There we go. So what might actually happen? Inaction due to political gridlock is the first scenario. Could happen, but probably not. We think they are going to cut a deal. This is one of those few times when we will look in our crystal ball and tell you what we see. The second scenario is a short-term, smaller deal to kick the can down the road. We think that's probably what most likely will happen. And the third scenario is the grand bargain, possible but not likely. So the least likely scenario, we think, is actually going off the cliff. Now, while they may not get along publicly, what's happening that we don't see? Time for another quote. This is from Harry Truman. John Adams and Thomas Jefferson were political enemies, but they became fast friends. When they passed away on the same day, the last words of one of them was, quote, "The country is safe, Jefferson lives," unquote. The last words of the other was, quote, "John Adams will see that things go forward," unquote. That gives us hope that they just might find things, and we will get through this. So how have the markets responded to past crises? This slide shows the performance of a balanced investment strategy of 60% stocks and 40% bonds, which is where most of you are, but it's a good model. Each crisis has labeled by the year and month in which it occurred or peaked. The subsequent 1 year and 3 year, 1, 3, and 5 year annualized returns start from the first day of the month following the crisis. Although global investment strategy would have suffered losses immediately following most events, financial markets recovered over time as indicated by the positive 3- and 5-year cumulative returns. Negative events such as these may tempt investors to flee the financial markets, but diversification and long-term perspective can help investors apply the dividends to ride out the storm. By the way, how are we doing today? This slide is from Russell Investments that they publish an update of quarterly. This is the most recent data. The point of the slide is this. Look at the shaded blue part of each line. That's the typical range for that particular statistic. In every case, where we are today is at some point in the typical range. So things aren't horrible right now. While they may not be great, they're not horrible. Right now, things are within acceptable norms, believe it or not. So what do? Control what you can control, and don't worry about the rest. What can you control? Your goals. You can manage risk, which is what you hired us to do for you. Choose the risks that actually paid off, which we help with. We pay attention to expenses, and we support you in being disciplined. So have some goals. What's the point? Why are you investing? For retirement? To accumulate money for retirement? To support you in your retirement after you are retired? To build family wealth? For your education or for others in your family, children, grandchildren, another home, whatever it is? Be clear about why you're investing. And the second thing we can do is manage risk. And I want to divide risks into two categories. And some of you may have heard this from us before. Yeah, we're a bit of a broken record about these things because that's what matters. So we're going to divide risk into two categories, unsystematic risk and systematic risk. Unsystematic risk are those risks that are specific to that particular investment, a company, a stock, piece of real estate, etc. What's the risk of investing in that company versus another, that piece of real estate versus another? And then there's systematic risk. Those relate to the whole market, for example, stock market risk or real estate market risk. So we can manage unsystematic risk by diversification. You buy a bunch of them. If you own 500 stocks in a mutual fund and one of them has problems, it may have a small effect on the overall performance of the fund, but you're not really slapped hard. If you own a portfolio of real estate properties and one of them has troubles, it doesn't drag them all down. So that's how you reduce risk. And there's actually studies that have done it. So it's at a certain point in diversification, you've essentially eliminated unsystematic risk for all practical purposes. The other risk that we're going to talk about is systematic risk, which are those that affect that particular market. And the way you reduce that risk is through asset allocation. You place your investments in different kinds of investments that tend to act differently in different environments. For example, U.S. stocks and foreign stocks, real estate, bonds, that sort of thing. What else can you control? You can choose those risks that actually pay off. You know, the risk-reward payoff. You pick those risks that actually pay off with some reward. In the stock market, research by Fama and French, Gene Fama and Ken French, indicate that three factors are where investors are best paid for taking risk. That's by being in the stock market versus in bond markets or CDs. By the size of the investment, smaller companies tend to outperform large companies, and value versus growth. Value companies tend to outperform growth companies. The size and price effect, and where you see a BTM that's book to market, that's a way of measuring value, affects both in U.S. and global markets. This graph illustrates the higher expected returns offered by small caps and value stocks in U.S. and non-U.S. and emerging markets. So if you look at the graphs for a minute, let's take a look at the graphs. The first graph with the dark blue is large stocks, value versus growth. You can see that value has done better than growth. The second graph is small, with the light blue, is small companies versus large companies. You see the same thing, but the numbers are higher than they were for the small. So if we look at this graph, the first big blue line says that this is the market premium, that is from 1927 to 2011, a long period of time. Stocks earned on average almost 8% more than government bonds. The size premium is the next one. Excuse me. And that showed that small stocks on average earned 3.6% more than large stocks. The third bar shows that value stocks tended to earn 4.7% more than growth stocks did. Continuing at what you control is costs and expenses. Trading costs. We've talked to you all about trading costs. We either use no transaction-free funds, or we use no-load funds with low trading costs by using Fidelity or TD Ameritrade or one of our other custodians. We look at the management fees of the mutual funds to keep them as low as we can, and we make sure that the companies that are in the mutual funds are paying attention to the bid-ask spreads, that is the difference between the buy and sell price, excuse me, of the stock or bond. And then we want to talk about the other thing you control is being disciplined. Stick to your strategy. There's no academic evidence whatsoever that anyone at any time can consistently beat the market by timing. The challenge is if you get out, when you get back in. A recent study shows why. This is from October of 1990 through September of 2010. And it shows that if you were fully invested for those 5,040 stock market trading days, you'd earn just over 9%. If you missed the best 10 days, you would have gotten a little better. You'd have got about 60% of that. I'm thinking the math works out to be about 5.3%, about 5 1/3. If you missed the best 20 days, just under 3%. And if you missed the best 30 days, if you were in the market 5,010 days, and you missed the best 30, you would have got less than 1%. Another look at it is for a longer period from 1970 through 2011. In this particular slide, you can see that the stock market, the S&P 500 earned 9.8%. If you missed the best one day, you can see what even then you didn't do as well. If you missed the best 5 days, etc. So trying to forecast which days or weeks will be good or bad is a guessing game that can prove costly to investors. The point is no one knows when the next big day will come, but you sure don't want to miss it. So in review, what can you control? Research shows that investors earn less than what they could in this study by Zweig and Morningstar, looking from 89 to 94. The average mutual fund earned 12.5%, while the average investor earned 2.2%. In a Dalbar study that went from 20 years ending 2009, the average mutual fund earned 8.2%, but the average equity investor only earned 3.17%. Why is that? Well, people waited until it was going up, had gone up, was already up before they bought, and then when it was going down, had already gone down, they got scared and sold. So being disciplined and sticking to your strategy is the way you make money in the market, not by buying when it's going up and selling when it's going down. So in review, let's talk about what you can control and what you don't need to worry about. Have goals. We manage your risks. Choose investments that pay off. Have a typo there. Expenses matter. And be disciplined. Control what you can and don't worry about the rest. Don't fall prey to the talking heads, the political people in the media. Keep a cool head. Okay, I'm going to end up with a couple of my favorite quotes. The first one is from Sir John Templeton, one of the legendary investors of all time. To buy when others are despondently selling and to sell when others are greedily buying requires the greatest fortitude and pays the greatest reward. Next one is from Warren Buffett. Look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participating in it. And my favorite of all times, again from John Templeton, the four most dangerous words in the world are investing is it's different this time. So that concludes my part of the presentation. I'm going to turn it over to Debbie now, who will talk about year-end tax planning. And there we go. It's all yours, Debbie.
Great. Thanks, Jim. So I'm just looking at the clock, and one thing I wanted to touch base on for the benefit of our audience is that this webinar is intended to be an hour long. And Jim, you were very efficient with your use of time, and if anybody, I wanted to talk about questions. So if you have any questions, either right now for Jim, we could take just a couple of minutes and answer those, or at the end of my presentation, then there will also be some time for questions on either mine or Jim's presentation. So if you want, you're all on mute, so we can't, we don't have the ability to have a verbal interaction, but on your webinar screen, there's a bottom, towards the bottom of the menu, the GoToWebinar menu, there's a place for you to type in questions. Please feel free to type those in at any time. That way you don't lose them. And like I said, we'll have time at the end of the presentation to go over both, but if anybody has any now before we get started with the year-end tax planning, we'd be happy to take just a couple minutes on those. Okay, and I'm not seeing any pop-up. So with that, then I'm going to go ahead and make the transition to the financial planning topic of year-end tax planning. And I just want to take a moment and kind of circle back to one of the comments that Jim made about the connection between his presentation and my part of the presentation. And his information that he talked about, the economic outlook and the markets and how that all plays, that's great. It's a great backdrop for the things that I'm going to be talking about today. And as you could feel, Jim's at a much higher level at the economic outlook, whereas some of the most important work we do is taking that information and then bringing it down and giving it life in your individual financial plans. And so there's a couple of slides that Jim and I shared that you'll start to see the theme of how it works by taking that big global look first and then drilling down into the individual planning. So a typical or traditional way that people talk about year-end tax planning that I hear a lot out there when people are asking me questions about year-end tax planning is the focus of now or this year. And you do that by accelerating deductions and pushing income out as far as possible. So the notion is that you increase your deductions, anything that you can do to bring them into the current year, rob them from next year, so to speak, and income that you can push on out to next year instead of recording it this year, that you want to do that. And the focus that I hear people kind of talk about sometimes is I want to lower my tax bill now in the current year. And while in some situations that makes a lot of sense, in many it doesn't, and it's actually to an individual detriment. So my talk today is going to, what I'm planning on going over today is how we manage that. So the year-end tax planning, we need to have some sort of framing of how we decide which situation it makes sense to focus on now, or it might make sense for us to pay additional tax this year because it's a more advantageous year to do that, and especially given the fiscal cliff, we certainly want to take that into consideration. So I'll talk about our framing. I'm going to go through some information that is data related. I promise I won't bore you with too much of it, but they're just important pieces, and I'll just give you enough detail to make a few important points. And then lastly, I'll walk through a couple of examples just to highlight or illustrate the way we think and approach year-end tax planning. So the fiscal cliff, as Jim mentioned, it's a pretty scary thing, and here we are sitting and looking at it and wondering what to do. You saw this slide or this information a little bit earlier in the presentation, and Jim walked through that quite a bit. The first few items on this this table really relate to the individual and the tax planning that we want to definitely be aware of. You can see towards the middle there we have some Affordable Care Act. I'll talk just a bit more in detail about those, and then the rest of the bottom half of this table talks a little bit more about spending cuts and other things that aren't necessarily related to individual planning. So one of the things that we've been talking a lot about as we're going through our year-end tax planning with our individual clients is, what do you think is going to happen? And so what we have is, I really like this table. It was put together pre-election, and so you can see that there's one column that is irrelevant at this point. Well, actually, 3 columns that are irrelevant at this point. But if you look at the third column, this one here, the Obama presidency and the split Congress, what is likely to happen? And so we can see that there's a pretty good belief that those who earn $250,000 in income each year are likely going to face some tax increase. Those under the 250 are likely not going to be much affected by the income tax. Looks like the AMT, the Alternative Minimum Tax Credit patch that they typically do is going to be extended. We hope so. That would be a terrible thing to play into this year. Payroll tax holiday, don't think that's going to happen. And then, of course, we've got the Affordable Care Act that does appear as though it's going to happen. So one thing that I want to just walk through, this is a very overly simplified, but it illustrates an important point. And when we talk about year-end tax planning, there's two concepts to make sure that we're just clear. And so with that in mind, we have the adjusted gross income, which is basically all of your income added up. It's the last line on your 1040 form on page 1, so at the very bottom. And that relates to a lot of things that we talk about in tax planning. But then also taxable income also is another important number that we like to look at and focus on. And so the difference between those two is we just, overly simplified again, but to illustrate the point, we have the adjusted gross income at the bottom of page 1. You subtract out your standard or itemized deduction, you get your personal exemptions, and then you have your taxable income. So right now, this year, for 2012, this is what our taxable income table looks like. And this is where the tax is applied to. So I'm not going to go through the detail. I promise I won't get into too much detail. But in essence, what we do when we're planning is we'll look at, okay, how's the client filing? And then where do they fall in these tax brackets? And that gives us some information, and it's important information for us to look at, and I'll touch on it later. One thing I wanted to do is I wanted to take a moment and do a comparison for the tax rates. So if we go over the fiscal cliff and tax rates revert to the 2001 level compared with where they are now, what we're looking at is on the right-hand side here, somebody who has taxable income of $200,000. They're going to pay, in essence, $53,000 let's see, in this year they would pay $43,000, nearly $44,000 in federal tax, and have an effective tax rate of about 22%. This time next year, if the tax tables reverted, this is what they'd be looking at: $53,000 and change, and an effective tax rate of 27%. Oh, too fast. Same idea of comparison. This is for a taxable income of $100,000. You can see the difference in how it affects the total tax paid and the margin and the effective tax rate. Okay, so the couple points to keep in mind as we're going through year-end tax planning. So the Obamacare tax impact, for those with the AGI of $250,000 or more, that's for married filing joint. It's $200,000 for single filers. On net investment income, there's going to be a 3.8% tax. And then for wages on individuals with $200,000 adjusted gross income, or for married filing joint with adjusted gross income of $250,000, there's going to be 0.9. So related to that, capital gains rates are scheduled to increase. You can see in 2012 we have a 15% capital gains rate, and of course that's a long-term capital gains rate, and there's a lot of talk that can go there, but I won't get into too many details unless somebody has questions. But in 2013, that's scheduled to go up to 20%, and then of course if you're one of those high-income investors, you're looking at the additional 3.8%. I apologize for the poor quality on this, but there's some just important points to note. We don't need to pay attention to the numbers, although we pay attention to the numbers. You don't need to for the sake of this webinar today. But the education planning. So the thing I'd like to point out here is that there are education credits and deductions that are available. However, they are adjusted gross income related, and they phase out for the higher income earners. Long-term care premiums, we talk a lot about the need for a long-term care plan, which sometimes can include insurance, and those premiums can be deductible. It's age related, and it's not necessarily, there's no income relation to whether they're deductible or not, but that's a piece of information. Health savings accounts, not income related. Rather, if you have one of these types of accounts along with a high limit, high deductible medical plan, we like to use these. These are great year-end tax planning tools. An important point to note is for our clients who are in the age range of 65 and above, subject to Medicare, we want to make sure that we keep in mind what the premiums are. The premiums are affected by your income. It's by a modified adjusted gross income, which is a big complex number, but it's definitely something that we take into consideration when we're going through our planning. Of course, we have our individual retirement accounts, or IRAs. Those, the important point to note here is that income limits do affect whether you can make a contribution to some sort of a Roth. Some sort of an IRA. There's three types of Roths that we like to talk about. The traditional one, which is you put the money in, you get a tax deduction, and then the money grows tax deferred until you take it out of the account. And then when you do take it out of the account, you have to pay tax on it. And you have to qualify in order to have a tax deductible contribution. Roth is basically the opposite in that you put the money in this year, you don't get a tax deduction, and then the tax and the account grows tax-free, and you never have to pay tax again when you take the money out of the account. A non-deductible, you can see here that there are no income limits. Anybody can put the money in there, and it's a hybrid of these two, the traditional and the Roth. So, just basically stated, what happens is you put money in a non-deductible, you don't get a tax benefit, but that money gets to grow tax-free. Not tax-free, tax-deferred. So when you now you have an IRA with basis, which means that part of, when you take the money out, you get to take part of it out, the part that's related to the original contribution you made, comes out tax-free, and then the earnings or appreciation, that part is subject to tax. Last point I'll make on this slide is that a Roth conversion, there is no tax, there is no income tax requirement related to being able to do a conversion. So this year, we're in a bit of the bizarro world, simply because of the fiscal cliff. Going back to the table where we had the likely scenarios and what we think is going to happen, Jim mentioned that we usually shy away terribly at making any kind of prediction or using our crystal ball in any way, shape, or form about the future and what lies ahead. However, this year, with regard to tax planning, we're willing to make a little bit more of a projection than we otherwise normally are. And we think that it's very likely that those who earn higher than $250,000 are likely going to face higher taxes next year, and those under are likely going to be not affected to the same extent. So what do we do with all that? So when we sit down and we do a review of our client's file, we take a look at it, we have 4 basic questions that we ask. And that is, are they in a high income situation? Are they 65 years or older? Is education planning and funding a part of their overall plan? And what does their portfolio look like? So when I talk about what the portfolio looks like, I am not even looking at the investments within it. That's a secondary look. Of course, we care about that, as Jim talked at great length about the investments and what we think about how the portfolio should be invested in terms of the investment vehicles. But for the purpose of year-end tax planning, when I'm talking about portfolio compositions, or what types of accounts. Are there after-tax accounts? Are there IRAs? Are there Roth IRAs? Any annuities? What types of accounts? So what does the portfolio have from that perspective? So I'm going to jump into an example here of the Ritchie family. So their annual income is about $300,000. It's a husband and wife. They're both in their late 40s. They have 2 teenage daughters, ages 13 and 15. And their portfolio, their total portfolio is $1,050,000, and it's comprised of $400,000 of a rollover IRA, $100,000 in a Roth IRA, $50,000 in education savings accounts, 529s, and they have $50,000 in an after-tax brokerage account. That after-tax account is generating about $30,000 in portfolio income, and it has an embedded capital gain of about $60,000. It's an unrealized gain. So in looking at the Ritchie situation and starting to think about their tax planning, what we note is that they're high income, education is a part of their plan, and we have some opportunities within their portfolio. So the strategies over off to the right-hand side of this slide, I'll kind of run through a bit of the strategies that we'll be looking at for them, and that is focusing on income shifting and how we can reduce their income to get them below the thresholds of perhaps being subject to the Medicare 3.8% tax on their portfolio, or just, any way that we can help offset some of the higher tax that affects the higher income earners. And, I'll take a quick tangent and note that most of my conversation here today, or almost all of it, is related to the federal tax. But if you live here in California, there's also some additional benefits to lowering the taxable income and getting that down under $250,000 here in California. Many of you know that we just passed Proposition 30, which levies an additional tax on those earning over in excess of $250,000. And that begins in 2013. So that's yet another reason. We want to take a look at and make sure that, to the extent it makes sense, kind of a big, obvious duh, we want to make sure that the 401ks are being fully funded. And then we'll also take a look at the IRAs. Obviously, the richies, because of their income, wouldn't be eligible to make a direct contribution to their Roth, but in a moment I'll talk a little bit more about indirect Roth contributions. That might be an area that we can do some good work for them. Also, on the income shifting, where does that $300,000 of annual income come from? Is that wages, or is one of the earners a sole proprietor? If they're a sole proprietor, there's some great work that can be done with regard to the children and the education funding by paying the children. Each of the kids will have some tax capacity at a much lower tax rate. We have to be mindful of the kiddie tax rules, but there is some capacity there, and there's some good work that we can take a look at. With regard to the portfolio allocation, looking at Roth conversions, especially in this year in 2012, does it make sense to do any type of Roth conversion? And the notion, just kind of in summary and overly simplified, but to the extent that we can get money out of that taxable portfolio and into a Roth environment, it definitely makes sense. And there's a lot of math that goes behind that, but that's definitely one of the strategies we take a look at. Of course, we might want to take a look at that $500,000 also and see if it makes sense to do any 529 funding, increasing those balances. There's some things to be aware of there. Does that make sense? And in some cases it does. If you're sure that you want to pay for the children's education 100%, but if you're not sure, then a Roth is likely a much better option to go with. And of course, you can always look at gifting to the children and just gifting to them outright. One quick tangent I'll make here is that we do some very extensive education planning, and related to that, in a high income situation, it would definitely be worth a conversation to talk about gifting to the kids, and if that makes sense. We wouldn't be talking about that perspective and strategy if we were a type 2 family or a family that's not considered high income. So lastly, one of the things that we keep in mind in this situation is we'd want to be mindful of capital gains loss harvesting. And what that means is, does it make sense to go ahead and recognize those gains this year, given that we have a much lower tax structure on capital gains versus what we're looking at next year? And it's likely that that's the case. But again, those are some of the things that we take a look at. So my second example is Mr. and Mrs. Leisure. And their annual spending is about $180,000 a year. That's supported by $70,000 in pension income, $60,000 in Social Security, and they're taking a draw from their portfolio of $50,000. Now, note that I'm not talking about their income here, because it's a much different situation when you're in retirement, and we take a look, we anchor on spending. That becomes much more of an important focus when we're talking about retired clients. So as you can see that they're age 66 and 64. They have no children at home. It makes sense. And their total portfolio is $2 million, consisting of $1 million rollover IRA, $200,000 in a Roth IRA, and $800,000 in an after-tax account that's generating about $100,000 in portfolio income. Wow, that's a great rate of return, isn't it? In any case, these are hypothetical examples. And it has about a $60,000 embedded capital gain. So for the leisures, our tax planning, what we're going to do is we're going to take a look at what is their tax bracket. Going back to that tax table that I showed you just a little bit ago, they're likely going to be in the 25% tax bracket. And so they're likely going to have some headroom. And by that, what I mean is, you know, the upper end of that tax bracket, if I remember correctly, is somewhere in the neighborhood of $160,000. And so if their taxable income is at $130,000, well, then they have $30,000 headroom before they jump up into the 28% tax bracket. It may make sense for us to go ahead and do a Roth conversion of that $30,000, use up that headroom, and put money into the Roth so that in the future we can perhaps keep them down in a lower tax bracket, or if they have some big expenditure that comes up, that we're going to be able to more effectively utilize their portfolio and not trigger big tax draws from should they need a big distribution. And it also allows us to start working on reducing that after-tax account and putting it in more favorable, tax-favorable types of accounts. The things that we want to keep in mind in that situation are medical premiums, or Medicare premiums. I showed you the table where the adjusted gross income has an effect on what you will pay for a Medicare premium. And of course, we want to take a look at the capital gains and losses and think about, does it make sense to do some matching up there. So the last family that I'm going to talk about is the Smith family. Their income is about $150,000. They're husband and wife in their late 40s. They have 2 daughters, ages 8 and 10. And their portfolio is $100,000 in a rollover IRA, $20,000 in a Roth, $20,000 in education savings accounts, and $30,000 in an after-tax account that's generating about $6,000 in portfolio income and $6,000 capital gain embedded. So the strategies that we would take a look for them, again, of course, we want to take a look at the Roth, the 401k deferrals and make sure that we're using those. On the portfolio allocation, we want to take a look at, does it make sense for them, because they can contribute directly to a Roth IRA, should they go ahead and make those? Even if they don't necessarily have the tax flow from their income, we can take the contributions from this after-tax account and use that to fund their contributions. So with this type of family, we definitely want to be careful with the types of accounts that we're using, because in education funding, this family may be eligible for some free monies, federal grants or low-cost loans, and so we want to make sure that we're positioning their portfolios so that they're in the best position possible, and of course the gains and loss matching. So again and again, I've referred to the Roth IRA, and I thought it would probably be worthwhile for me to take a moment and tell you why we like the Roth IRA so much. And that is because, as I mentioned just a little bit ago, that once the money's in the Roth IRA, it is tax-free. It gets to grow tax-free. You don't have to pay tax on the appreciation, whereas like an after-tax account, of course, you're going to be paying portfolio taxes on the portfolio income it spits out. And when you take the money out of the account, it's not taxed. It's not subject to income tax. Once you make your contribution into the account, and it's been in there for 5 years, you can take the money out tax-free, the contribution, the amount that you put in, tax-free and penalty-free. You don't have to be 59.5. You don't have to have any sort of qualifying reason like hardship or education or medical. You can just take it out after it's been in there for 5 years. I talked a little bit about our approaches, our approach to conversions. We like to fill up the tax brackets. Sometimes, you know, if you're in a low tax bracket the last couple of years, if a client's been in the 10 or 15% tax bracket for whatever reason, we've filled up the 15% and had some really great conversations about, does it make sense to you know, tread into the 25% tax bracket. So, you know, that again becomes a conversation, a one-on-one conversation that we have during our meetings. So the annual contributions, you can make an annual contribution if your AGI is 107,000 or less and you're filing single, or 169,000 if you're married filing joint. The indirect, that works really well if you have if you don't have a traditional or deductible IRA. So for example, if we have a client who has $100,000 in an after-tax account, it's spitting out portfolio income that is really starting to, we're worried about how it's going to be taxed in the next few years. All of their retirement assets are in their 401k. They do not have any type of a rollover IRA or a traditional IRA. Well, then what we do in that situation is we go ahead and just open up an IRA, make a non-deductible contribution, and then automatically convert it. And it's as if you were making a direct, you know, just direct contribution to your IRA. So that's a really great planning tool for those who have, you know, good income and all their retirement assets are in their 401k. So to, you know, wrap it up on the Roth 401k, the Roth IRA, we see them as wonderful education funding planning tools because they are so flexible. You can take the money out after it's been in there for the 5 years, use it for however you like. You can take the earnings out for education. You do have some no penalties, but the earnings would be included in income tax. But it's just a great tool for education planning for a lot of reasons. And then income tax management in retirement, and I talked a little bit about those thoughts. So just a couple last little things I wanted to make sure I threw out there. The threshold for deducting medical expenses, right now there's a floor, so to speak, so 7.5% of your AGI, your expenses, medical expenses beyond the 7.5% of your AGI in 2012, you can claim those as a tax-deductible expense. Next year, that floor is going to 10%. The child care credit is expired to, or is scheduled to expire in 2012. So some of the most common tools that that we use here at Lighthouse is the capital gain and loss analysis, the Roth contribution conversion, education planning. We can do a lot with that, and then the income tax planning and retirement. And you know, one strategy I haven't talked about, and I'll just briefly describe it here, is the we want to maximize the gap years, and those are typically the years between when you start receiving Social Security. That can be as late as 70 in some cases, you know, maybe 66 or 67 for some of you. But if for some reason you're not taking Social Security and you're not in your required minimum distribution for your IRA, that can be a great opportunity for us to look at how to maximize the Roth conversion. So that concludes all of my prepared comments, and we'll go ahead and open it up and see if anybody has any questions. I'm not seeing any questions. So with that, Jeanette,